There is a specific kind of silence that precedes a structural shift. It isn't the silence of peace, but the silence of a system holding its breath. For those of us who have spent decades building equity, layering brick upon mortar and contract upon contract, we've grown accustomed to a certain level of background noise. Market volatility, interest rate hikes, the usual geopolitical friction. But recently, a new frequency has emerged, one that requires our undivided, analytical attention. A recent report from Bloomberg has confirmed that the FBI is currently assessing a significant breach of a major real estate finance tech vendor. On the surface, it looks like just another headline in an era of constant data leaks. But if we look closer, if we apply the intellectual honesty this moment demands, we see something far more systemic. This isn't just a hack. This is a canary in the coal mine for the high-net-worth investor. It is a signal that the very plumbing of our wealth, the digital architecture that houses our real estate holdings, is under professionalized siege. Welcome to the horizon. Today, we aren't going to react with the panicked fervor of the day trader. Instead, we are going to perform a forensic audit of a concept we've taken for granted: institutional trust. We are going to analyze why your equity is no longer just a physical asset, but a digital target, and why the professionalization of risk means the old rules of asset protection are officially obsolete. If you are over 40, you've likely spent your life trusting the institution. It is time we discuss why that trust must now be replaced with personal digital sovereignty. To understand where we are going, we must first understand that the history of civilization is, at its core, the history of the ledger. Every major leap in human cooperation was preceded by a leap in how we record who owns what. 5,000 years ago in Mesopotamia, we used clay tablets to track grain shipments. It was a primitive ledger, but it allowed for the first complex trade networks. In the 14th century, the Medici family and the merchants of Florence didn't just invent banking. They popularized double-entry bookkeeping. This was the code of the Renaissance. By recording debits and credits in a way that had to balance, they created a system of internal verification that allowed capital to flow across borders with a new level of confidence. This single intellectual breakthrough, this ledger revolution, laid the groundwork for the modern corporation and the global age of sale. In the 20th century, we moved those ledgers into the digital realm. We built massive databases, silos managed by banks and clearinghouses, and we called it progress. But here is the catch. These digital ledgers are not common. They are private, proprietary, and they don't talk to each other. When you send money or transfer a deed, your bank updates their private ledger. Then they send a message to the other bank, who then updates their private ledger. It is a game of digital telephone. We have traded the physical paper for digital paper, but the underlying logic is still based on manual reconciliation. We are still living in the era of Excel-based trust. We are now standing at the edge of the next great leap: the transition from private, siloed ledgers to shared, universal ledgers. Let's perform a deep dive into the real estate tech stack. If you own a commercial property or a significant residential portfolio, you likely view your risk through the lens of occupancy rates, cap rates, and physical maintenance. But your true vulnerability lies in the financial plumbing. This is the invisible layer of APIs, legacy database structures, and cloud-based management systems that handle everything from your mortgage servicing to your title insurance. The Bloomberg investigation highlights a critical fracture in this plumbing. Many of these tech vendors are operating on what we call legacy debt. They are using old database architectures patched together with modern web interfaces. It's like putting a glass facade on a 1920s tenement building. It looks modern, but the pipes are rusted and the foundation is shifting. When a vendor is compromised, it's not just your email address at risk. It is the integrity of the transaction record itself. In the digital age, your equity is essentially a permission granted by a database. If an adversary gains control of that database, or the APIs that communicate with it, the distance between owner and dispossessed becomes dangerously thin. We must stop viewing tech as a convenience for our real estate investments and start viewing it as the primary risk vector. Your bricks and mortar are now tethered to a digital ghost, and if that ghost is exorcised by a malicious actor, the physical asset becomes an island with no bridge back to the financial system. The final element of this shift is the professionalization of risk. We need to move past the outdated trope of the hacker in a basement. The entities that the FBI is tracking in reports like the one from Bloomberg are industrial-scale adversaries. These are state-sponsored groups and highly organized criminal enterprises that treat cyber risk as a business model with a high ROI. They aren't looking for a few $1,000s. They are looking for the keys to the kingdom. They are targeting the systemic bottlenecks in the real estate finance sector because they understand that this is where the most significant equity resides. This is industrialized theft. They analyze the tech stack of a vendor with the same rigor that you analyze a P&L statement. They look for the sovereignty gap, the space where an investor has handed over control, but the institution has failed to provide adequate defense. When the Bloomberg report mentions the FBI's involvement, it's a signal of the scale. This isn't a localized fire. It's a systemic threat assessment. As men who have spent our lives managing risk, we must acknowledge that the nature of the adversary has changed. We are no longer defending against random acts of digital vandalism. We are defending our life's work against professionalized, well-funded organizations that view our equity as their next quarterly target. This realization shouldn't cause panic, but it should prompt a deep, analytical pivot in how we secure our assets. The era of passive security is over. The era of the active risk manager has begun. We begin Part B by addressing a concept that most investors over 40 have rarely had to question: the sovereignty gap. For decades, the definition of ownership was simple. You held the deed, the title was recorded at the county office, and the physical asset, the brick and mortar, stood as the ultimate collateral. But as the Bloomberg report on the FBI's investigation into major real estate tech vendors illustrates, the financial plumbing that connects you to your equity is no longer made of steel and concrete. It is made of code, and that code is increasingly externalized to third-party vendors who do not share your personal risk profile. The sovereignty gap is the distance between your legal right to an asset and your technical ability to control or liquidate it during a crisis. When a vendor responsible for real estate finance, the bridge between the bank, the title company, and the investor is compromised, your ownership enters a state of digital purgatory. You may own the building, but if the ledger that validates your equity or facilitates your debt service is under the control of an industrial-scale adversary, your sovereignty has been effectively severed. This is why we must look past the shock of the Bloomberg headline. The FBI's involvement isn't just a sign of a crime. It is a sign that the systems we trusted to be too big to fail are, in fact, too complex to secure. For the mature investor, the realization must be this: holding a legal title is a 20th century solution to a 21st century risk. If you do not have digital custody of the pathways to your equity, you are an occupant in your own portfolio, not the owner. We must bridge this gap by moving from a model of institutional trust to one of verified sovereignty, where we acknowledge that the tech stack is now a primary component of the asset's value. To protect your equity, you must learn to evaluate your portfolio's tech stack with the same rigor you apply to a cap rate or a structural inspection. Section 6 focuses on this strategic framework. As men who have built wealth through cycles of stability, the instinct is to trust the brand name of the bank or the REIT. But the Bloomberg report reminds us that these institutions are often just front ends for a labyrinth of vulnerable third-party APIs. When reevaluating your holdings, you must start asking the horizon questions. First, who manages the data between the lender and the title? If your REIT or bank relies on legacy database structures or monolithic vendors that the FBI now identifies as high-value targets, your risk is concentrated, not diversified. Second, what is the failover protocol? In the event of a vendor breach, does your institution have a redundant, offline path to verify your equity? We must audit our digital vendors as if they were physical contractors. You wouldn't hire a property manager who leaves the front doors of your buildings unlocked. You can no longer afford to partner with financial institutions that outsource their digital doors to the lowest bidder tech firm. The professionalization of risk means that a vulnerability in a secondary software vendor is now a direct threat to your family's long-term equity. This isn't about becoming a computer scientist. It's about becoming a digital fiduciary. You are looking for security by design, institutions that prioritize hardened infrastructure over the convenience of a flashy user interface. If the tech looks too easy, it's likely because they've removed the friction that actually keeps the hackers out. This brings us to the shift from convenience to sovereignty. For years, the fintech industry sold us on the dream of frictionless finance. We were told that managing millions in equity should be as easy as ordering a coffee from an app. But for the over 40 investor, frictionless is now a synonym for defenseless. The Bloomberg report is a signal that we must reintroduce intentional friction into our financial lives. Personal digital sovereignty requires a transition to hardened security. This means moving beyond the basic security measures that the average consumer uses. SMS-based two-factor authentication is no longer sufficient. It is a vulnerability waiting to be exploited through SIM swapping. Sovereignty means utilizing hardware-based security keys, physical tokens that ensure only you, in physical possession of the device, can authorize a movement of equity. It also means adopting encrypted communication channels for all discussions regarding your real estate transactions. If you are discussing a six-figure wire transfer or a deed transfer via unencrypted email, you are broadcasting your equity to the industrial-scale adversaries the FBI is currently tracking. Sovereignty is the willingness to choose the hard path of security because you understand that the easy path is a trap for your long-term wealth. This is a mindset shift. We are moving from being passive beneficiaries of a system to being active managers of our own digital borders. It is a sober, intellectual commitment to the idea that if you do not defend your data, you cannot defend your dirt. In conclusion, the horizon view is not one of panic, but of prepared evolution. The Bloomberg report and the subsequent FBI investigation into our real estate infrastructure aren't signs of an impending collapse. They are markers of a maturing world. We are witnessing the end of the handshake era of finance and the birth of the protocol era. As men who have spent decades building a legacy, our task is to ensure that legacy isn't erased by a line of compromised code. We aren't abandoning the real estate market. It remains one of the most resilient stores of value in human history. Instead, we are evolving our defense. We are recognizing that digital security is now a fiduciary duty, a responsibility we owe to our partners, our families, and our future selves. Maintaining composure in the face of these headlines is your greatest asset. While others react with fear or denial, we react with analysis and action. We audit our stacks, we harden our access, and we reclaim our sovereignty. The future of wealth does not belong to those who ignore the shift, but to those who have the intellectual honesty to adapt to it. This is the horizon, calm, analytical, prepared. We will continue to monitor the plumbing of the financial world, so you can focus on building what matters. Until next time, stay sovereign.